Hello again, everyone, and welcome to those of you who are joining us on the live stream. Thank you so much for being with us today. So for those of you in the room, I've already introduced myself once, but I'm going to do it one more time just so the people online know who the heck they're talking to. Hi, my name is Shannon Ward, and I'm Chief Growth Officer here at Genus Capital. I'll be your host for today. We have an exciting event for you today, given how fascinating events were last year, what we're looking forward to for 2025, and we've brought some of our best and brightest from the team today to share with you our insights into what happened last year in the markets, how Genus responded to those changes, and what we foresee to be happening in 2025 and beyond, and what we're going to do to respond to those changes as well. So today I have some fantastic presenters with me. We have Wayne Washell right here, who's our Executive Chairperson and Chief Investment Officer. Stephanie Choi, who's our Chief Sustainability Officer. Justin Hahn is our macro analyst, and over at the end, last but not least, Sebastian Rayam is the managing partner from Alpha Fix, and they are our fixed income sub-advisor, so he'll be here to talk to us all about bonds today. So as I mentioned, we'll go through a few different sections today in terms of what we'd like to cover with you, and each speaker will cover a different angle. The theme is that we are looking for a soft landing. We actually have optimism for that. We are entering a turbulent year. I'm sure that is not a surprise to anyone. And Stephanie will be focusing on how we are innovating, so what we're doing to meet our clients' needs and to really change and evolve with you during these changing times. Justin is going to go more into the market, so he'll talk more specifically about that soft landing optimism, particularly as the Fed pivots. Sebastian, as I mentioned, will go into the fixed income side of things and the success, actually, that was found in quite a volatile year. And then we'll finalize with Wayne, who will talk about the geopolitical risks, so all of the immense drama that we have going on and how that will affect things and how we've responded. So I think it'll be a really interesting conversation today. We also have the opportunity for questions. So for those of you online, the way to submit your questions is to go to slido.com and put in the event code there, which is hashtag GCM2025. So you can submit your questions at any time. And those of you in the room too, if you're hearing part of the presentation, you think of a question, you can put it in through the Slido, and then you don't have to wait to remember it later on. Or, of course, at the end, we will also have an open question and answer section where we'll have the mic and we'll go around and do it the old-fashioned way. So I want to introduce a few other people who are in the room. So we have our portfolio manager and client relationship manager team here. Most of them are sort of sitting sprinkled in with all of you. So I'll just go through each of them, and if you wouldn't mind just standing up when I do that so that people can start to put faces to names, please. So we'll start with Jill Bester, who I see right in front of me. There's Jill. And then Daryl Brown in from Toronto. Tiffany Lusher. There's Tiffany in the back. Grant Conroy. Oh, yeah, over there. Thank you. Thomas Irwin, standing at the door there. Ian Lusher. And Sue Talbot, unfortunately, is sick today, so she's not with us, but she sends her regards. And Kenneth Sin. Where's Kenneth? There he is. Fantastic. Excellent. And then, of course, last but not least, Mary Lou Miles, way in the back. Okay, fantastic. And then I also wanted to, because I know a lot of you are clients in the room and many of you are clients on the live stream as well. It's always great to be able to put faces to names, I think. So I wanted to introduce a couple of people from our client service team as well. So Batul Tajani is in the back as well. So that's that face. It's a bit dark back there, so it's kind of hard to see the faces. But and Jazz Ranu is back there as well. And is Marina? Yeah, Marina Sequeira is here. Fantastic. And Amy is another member of the team, but unfortunately she's sick too. January just takes the people out, unfortunately. But we've got a lot of people in the room, so they're happy to answer any questions that you might have. You don't need to necessarily only ask a portfolio manager. We have a lot of the investment team out in the back as well. So we have a full strength of team here in order to support you and have any conversations that you might want to have. So please feel free to talk to them. And for those of you online, again, please use the Slido, and we'll try to get to as many questions as we can. The other note from a housekeeping perspective is there will be a recording that's available of this presentation. You will all get an email that has a link to that recording. So if you want to look at it again, or if you found it interesting and want to forward it to a friend or family, you can do it that way. And then also we'll have it up on our website for a long time. I don't know for how long, but for a long time. So you can find it there as well. So before we get into content, I just wanted to do a land acknowledgement. I'm grateful at this point for all of us who are in this room to be able to meet on the unceded ancestral and traditional territories of the Tsleil-Waututh, Squamish, and, sorry, I just lost my notes, and Musqueam nations. Reconciliation is, I think, is such an interesting topic at this moment. I spent some time a couple of years ago with Karen Joseph, who's Chief Robert Joseph's daughter, and his book on reconciliation, Namwayat, is, I think, the one that's impacted me the most of all that I've read. And he starts with talking about how reconciliation is about recognizing our connection to one another as humans. And I think particularly in these chaotic, turbulent, unprecedented, whatever other word you want to use, times, it's really good to remember that we are all connected to each other, and to remember that that role that reconciliation has. So this isn't just about recognizing the past. It's really about taking action for the future and remembering that it's our commitment to building relationships that are rooted in respect that is going to make the change that we're looking to have in the world. We are all in this together. And the more inclusive future that I think all of us want starts with each of us. So thank you for joining us today to be part of this and online. So with that, I would like to give it over to Steve Au, our CEO, and he has a few words of welcome for you. Thanks so much.
Thank you and good afternoon. On behalf of all of us at Genus, another warm welcome. Thank you for taking the time to come here in person and online and connect. Like Shannon said, it's about connection. An event like this is also good for the firm. You see a lot of our members are back there, and in this world where we're in a hybrid environment, it's also our opportunity to get together and connect. So it's great to see the office full. It's great to see people. We're going to have a CFA dinner tonight, and then we're going to have our annual celebration tomorrow. And so the next couple of days is going to be a fun one. I want to take this opportunity to thank our clients. Without you, none of this would have been possible. And we really value your continued support. But we see our commitment to supporting you, not just as our clients, but as partners in building a better future. And looking back at 2024, it turned out to be a year to celebrate. We went in through the year expecting volatility and uncertain times. And markets end up being kind. And you couple that with a strong performance from our investment team led by Wayne Wachell and Lisa Zhang back there. Lisa, can you stand up? There you go. Lisa is the head of our equity investment research group, and so she's a big part of our success. But for us, what's also very meaningful is the impact that these portfolios can enable. Because here at Genus, our core value, our number one core value, is fostering client success, your success. And we've been able to do that through investment performance, innovation in products, and also putting your core values at everything we do. Because we understand that behind every investment is a story. There's a reason why everyone's investing. And over the years at Genus, I've heard countless amount of client success stories. Recently, one was told to me, and it kind of touched home. A client shared with us how their investment journey allowed them to enable one of their dreams to come true. Through their investments, they were able to fund IVF treatments, and we've been told that they're expecting their firstborn any day now. And that's what impact looks like to us. It's those stories, much like that, whether it's buying a home, furthering education, setting up for retirement. That's the reason why we do what we do. That's why we show up every day. And we'll continue to do that. Going beyond our clients, creating impact for our team and for our community is top of mind. And that's why I'm also very proud to share that in 2024, we were recertified as a B Corp and as a great place to work. To me, that's our continued commitment towards sustainability, towards ethics, and creating positive change together. And as we look forward to the future, as Shannon alluded to, there's going to be some headwinds, but we still want to maintain our leadership role when it comes to sustainability and impact investing. And much of that vision is going to be carried out by the promotion of Stephanie Choi to our Chief Sustainability Officer. Stephanie's leadership is really going to forge the road ahead. And in a moment, she'll share her perspective on where we are and where we're going to go. And so we're looking for that continued success together. So I'll just end by thanking you once again for your continued support and allowing us to be part of your journey. It means everything to us. Today we're going to celebrate a little bit of our success and looking backwards, and also taking a look at the opportunities ahead. So thank you again, and I'll let Stephanie start us off. Thanks.
Good afternoon, everyone. I'm very excited to be here today, and thank you for being here. So, in this section, I'm going to talk about how we work to help align our clients' portfolios with their values. And also, we will also take a look at how our Genus impact equity strategies has done in terms of delivering returns, delivering impact for the planet, and impact for the people. And we'll also share some of our innovations, ideas, and also research initiatives and projects that we have planned for 2025. At Genus, one of our key missions and goals is to have solutions to meet where our client values are. And so for that, we have a full suite of strategies to cover the whole values-based investing spectrum. These 4 strategies could be often classified as responsible funds. So what it means is we do consider ESG factors within the fund, but they are mostly driven by risk management considerations. For example, all these 4 strategies, we require that the carbon intensity at the fund level, they have to be lower than their respective benchmark by a material margin. And for CanGlobe Equity, Dividend Equity Fund, we further cut out companies that are in the highest of carbon intensity, or they have the lowest ESG, environmental, social, and governance performance ratings. And also tobacco companies are cut out across the board. For fossil-free funds, these are essentially our socially responsible strategies, and this is where we divest to achieve better value alignment. So for these strategies, we use a combination of negative screening, some positive screening, and also deep ESG integration to make sure the funds are free of fossil fuels, low carbon, and also socially responsible. So the ultimate goal is really to achieve better value alignment for our clients and also to have very competitive risk-adjusted returns. Oops, sorry. And for impact offerings, we have both liquid and illiquid strategies for impact. So for liquid strategies, we have the High Impact Equity Fund and also the Global Impact Bond Fund. For these strategies, we basically invest in public securities of highly impactful companies to generate positive impact that could benefit the environment or the society, and also to achieve competitive market rate of returns. For clients that have more deep impact focus areas in different thematic areas, then we have the Impact Investment Council. So this is essentially our fully customized, fully managed impact portfolio management services. So then these clients can focus on certain areas that they're really passionate about. So one of the strategies that we have seen the highest growth and has a lot of interest from both our private and also institutional foundation client base is the High Impact Equity Fund. I understand that this is not in all of our clients' portfolio, but given the interest level, we think it's worthwhile to spend a little bit of time to talk about it. So this strategy mainly aims to achieve triple bottom line. Number one is competitive risk-adjusted returns and also impact for the society and impact for the environment. Over the last 5 years, our fund is represented by the blue line. So it has achieved 13.5% return on average over the last 5 years. As a comparison, the benchmark MSCI World, it is a very widely used kind of global equity index for equity funds that have a global developed markets focus. And for that benchmark, it has achieved 14% return per annum. So our fund tracks the performance of this underlying benchmark very closely, but with considerably lower risk. And in fact, this fund have been awarded the Top Performer Award according to one of the largest institutional database, GMR, that we are in the top 3% in terms of risk-adjusted performance compared to our global peers, which consist of about 270 other funds in the global equity space. And also from our own analytical analysis, recently we looked at the actual fund performance over the last 5 years. Impact as a factor has also contributed about 1.5% excess return for the strategy. Another key component of impact investing is impact measurement. We have to be able to measure it. And so for that, we use UN Sustainable Development Goals, United Nations Sustainable Development Goals. And it is basically a set of 17 goals adopted by all the member states of the United Nations in 2015. The goal is to really help to provide a roadmap for global governments to achieve environmental sustainability, social sustainability, and economic prosperity, equity for everyone on planet Earth. And for us, when we measure impact, we look at the percentage revenue of a company that is coming from impactful products and services that could be contributing to or taking away from different United Nations Sustainable Development Goals. And when it comes to our portfolio construction impact measurement, we look at net impact. What it means is we not only look at the positive impact of an investment, we also look at if the company has any negative impact. The goal is to make sure while we have the intention to do good, we are not also causing any harm in any other areas. This is the impact score for our high impact equity fund, broken down into positive impact, negative impact, and net impact. Positive impact could be coming from products and services of companies engaging in good businesses, such as education, healthcare, or renewable energy. And then negative impact could be coming from products and services of companies engaged in harmful industries, businesses, such as weapons, tobacco, gambling, or highly carbon-intensive industries. And to arrive at net impact, we subtract negative impact from the positive impact. For our fund, we do require that at the fund level, we have to have at least 50% net positive impact with no negative impact within the fund. And as of the end of last year, we have 55% net positive impact and no negative impact. And this is a stark improvement over our benchmark MSCI World, which has only 7% net positive impact at the same point in time. This is another view of how our impact fund can deliver impact. And it shows how the fund is aligned or strongly aligned with different UN SDGs. And the percentage numbers here shows basically the percentage of the fund market value that is aligned or strongly aligned with different UN SDGs. The top most aligned SDGs for the fund as of end of last year, including promoting gender equality, promoting responsible consumption, decent work and economic growth, reducing inequalities, and also affordable and clean energy. This is an example of a company that we invest in a high impact equity fund to give you a flavor of how your investment dollars are actually making an impact. Pearson, to me, I remember it being a textbook company back in my old school days. But over the years, it has transformed to an online educational company, providing a variety of educational products and also digital resources, which greatly support learning. And also, its innovative digital platform offers very personalized, interactive learning experiences. And Pearson has also partnered with a lot of universities, higher educational institutions to offer higher education, which also greatly enhance access to higher education for non-traditional students, for students in remote communities. And in terms of impact, it is quite spectacular. It has a 94% impact, meaning 94% of its revenue is coming from products and services that contribute to quality education, SDG number 4. And also, in terms of its overall ESG performance, it has done pretty well. AA, which is the second top notch. And also within our own proprietary stock selection model, it has a really good financial ranking. And also, as a company, it has done pretty well to reduce their carbon footprint. In 2023, it has reduced its carbon emission by 16% versus 2022. So apart from delivering values-aligned investments through our investment funds, in the past and present, we have also worked with a lot of our clients, to innovate and customize portfolios according to your values. With advancement in data over the last few decades, we can now practically customize a client's portfolio based on more than 5,000 different ESG factors. Oftentimes, we work closely with you to identify these values, and then we map these values to tangible ESG data. There are many different examples that we could talk about. For example, one of our clients really care about animal rights, and so we have incorporated relevant measures into their portfolio. Others really care about indigenous rights as well, and also biodiversity. They are some examples. In 2024, we have also added a child labor screen into our fossil-free and impact funds. So what it does is really to exclude companies that are involved in severe or very severe controversies related to the use of child labor in their own company's operations or throughout their supply chain. The goal of this screen is really to cut out or to minimize exposures of your portfolio to these most socially irresponsible companies manifested through the labor management practices. And we do this systematically through a scoring system. We look at a multitude of factors, including the company's role into these issues, whether it's direct, indirect, or the severity of the issues, and whether the company management itself has put in place policies, practices, and also made significant progress to rectify these issues. So what's new for 2025? We are quite excited about a few research initiatives and projects that we have planned for 2025. On the research front, we would like to spend some time to research on strategy that focuses on transition. Over the last couple of decades, in transition to a more sustainable future, lower carbon economy, we have seen that divestment has taken center stage as a key approach by a lot of asset owners, large asset owners around the world to promote climate action through their investments. Today, it is still one of the top, if not the top strategy used by these large asset owners. But at the same time, we have also seen more and more clients' interest that they would like to kind of focus on companies that have made meaningful efforts and also significant progress in terms of preparing themselves to transform themselves to be more prepared for the transition coming. And for these could be companies that are very well prepared in terms of risk management to reduce exposure to climate risk, whether it's transition or physical events. And then also could be companies that are very well positioned to take advantage of opportunities arising from transition. It could be through their investments in R&D, securing new technologies, changing their business model and business mix. So overall, we will really want to look at ways to systematically identify these companies alongside our engagement strategies. So this one would be more focused on both risks and opportunities as a result of transition. And then another key exciting project that we are working on right now, the team at the back is working hard on that. It's our first annual firm-wide impact report. So in this, the target launch date is sometime in middle of 2025, if not earlier. And in this report, we will take a close look at the sustainability footprints, environmental and social footprints, impact of Genus as a company through our operations and through our interactions with the communities and with our various stakeholders. We'll also take a deep dive into some of the strategies' impact in both the public and the private space, so then you could get better scoop in terms of the backstories of some of these impact investments. And finally, we'll offer some forward-looking assessments, industry outlook, and also potentially a feedback channel that you can bounce ideas back to us. So yeah, we are very excited about this project. So to sum up, we really look forward to continue to work with all our clients to align their portfolio with their values. And we have seen that our impact equity strategies has gained a lot of momentum and also garnered a lot of interest given changing demographics, changing mentality, and also we do see an imminent need for systems change to normalize investing to focus on both doing good and competitive returns. And stay tuned in 2025 for our new projects and new ideas. And with that, I think it is a great segue to let's shift the focus back to the market. So then you could have a sense of how the market could impact your portfolios from an economics and geopolitical point of view. And I'll pass my torch to Justin, our macro strategist, to talk about the outlook and summary of 2024.
Thanks, Steph. Good to see everyone here today and virtually. So as Stephanie mentioned, I will be discussing the current economic outlook in terms of what we saw last year and what we expect going forward. So last year, at the beginning of last year's seminar, if you guys remember, we were worried about a recession due to the high levels of inflation, as well as the issues going on with the global economic slowdown due to the high interest rates, as well as slowing demand for the governments. Despite this, there were weaknesses. There was excess government spending, which led to quite a bit higher economic expectations in GDP numbers and caused the economy to come in hotter than we expected. In addition, we also saw the global easing begin, with central banks all across the world beginning to lower their interest rates. So how have the central banks done in their fight against inflation? So last year was a very good progress on inflation. We saw inflation levels come down significantly. Although it has flattened out in the last 6 months of last year, we can see that it's a bit stickier than we would like, still way above the 2% target, although Canada has fared a bit better. The parts of the inflation that are sticky tend to be groceries as well as rent and housing costs, which in turn was because of the higher interest rates. But we expect it to go down slightly going forward. So why has the US not done as well? This is because of the excess government spending that I alluded to earlier. We can see from this chart here that government spending is about $170 billion a month, higher than the pre-pandemic average in the US. And the chart beside that shows that money printing, although which is M2, that's just all the liquid assets such as cash and checkings accounts, savings accounts, as well as money that's easily convertible to cash, such as T-bills. So that has gone down during 2022 and 23, but it actually increased during last year due to the excess government spending. So this chart shows you that inflation is a monetary phenomenon, and it's essentially too much money chasing too few goods. This chart shows that money printing on a year-over-year basis leads to inflation about 18 months later, and it's a push and pull between those two. The excess spending has also been a problem for governments. We saw that deficit to GDP ratios in the US are reaching about 7%, which are pre-recessionary levels, even though we're not anywhere close to a recession in the US. For context, this target is around 3% usually for deficit to GDP, and during 2008-2009, we saw those rates come all the way to 10%, as well as post-pandemic, it was roughly about 17%. Despite the deficits increasing, this is something that there is optimism about with the new DOGE committee, which is the Department of Government Efficiency, which is going to be headed by Elon Musk, and their abilities to cut some of this government spending. So despite the deficits increasing, we have seen that inflation has benefited the governments. So the governments have essentially been able to inflate away the higher levels of spending as government debt to GDP levels have come down with nominal GDP numbers going up. We also see that in Canada, these levels are as high as they were during the 90s, where the governments had extremely high budget deficits and higher interest costs. And we're also starting to see this become a problem with the excess spending in terms of cost to the government. From this chart, we can see that the US net interest costs are expected to reach about $1 trillion heading into this year, which is about 3.5% of GDP for the US. These levels could go up past 4% of GDP, and it's important to note that these numbers are based on projections, and during the last 3 years, these numbers have been coming in quite a bit higher than initially planned due to the excess spending, as I mentioned before. Although the debt levels have been beneficial to the governments, it has been a pain point for the consumers. So we can see here that real inflation-adjusted wages in the US have yet to reach pre-pandemic trend levels. It's still below trend, and this is kind of what's hurting the consumers on a day-to-day basis. So higher grocery prices, higher rent, higher travel costs, as well as big ticket items, and also why we saw the GST pause in Canada. In addition to the high levels of, in addition to it hurting the labor market, we also are seeing pain points in the housing market due to this. So the housing sector over the last year has been relatively flat, and this is a similar story in both Canada and in the US. We do expect this to bounce back, though. This is mainly, the reason is because the higher levels of interest rates. So if you've renewed your mortgage during the last couple of years, you probably saw higher interest payments as well as higher interest rates. But again, as I mentioned before, there is a global easing that's happening that has begun in the second half of last year. So what are the central banks planning to say, or what are the central banks saying heading into next year? So this chart shows the US Federal Reserve dot plots. So dot plots are just the average expectations of all central bank participants and where they expect interest rates to be over the next few years. So two things you can take away from this chart. The first one is the orange bar and the red line are now aligned, which means that the market expectations, which is the red line, and the orange bar, which is the Fed expectations, are now in line, and previously they weren't. And secondly, we see that the Federal Reserve has turned quite hawkish after the election. So in September, they were expecting about 3 interest rate cuts heading into 2025, but in the end, but in the December meeting, they are only projecting about 1.5. This is in part due to the new Trump administration and all the policy uncertainties that come with it. There's a lot of worries about tariffs and how they could be inflationary or not. So that's something that the Bank of Canada will also be watching. It'll be interesting to see next week what the Bank of Canada has to say in this matter and if they have adjusted their interest rate expectations heading into this year. Despite the US Federal Reserve and Bank of Canada both lowering rates, we have seen a bit of a divergence in the economies, and the US Federal Reserve has lowered rates less, only lowering rates by about 1% versus Canada, which has lowered rates by about 1.75%. This is mainly due to the unemployment rates in the US still being very strong, hovering around historical low levels of 4%, while in Canada, they've shot up from about 5% all the way up to about 6.8%. Although the unemployment rates have gone up, it has been pretty focused on the technology sector. This was plagued by overhiring during the post-pandemic and all the AI boom that's been going on. Despite all this, there are signs, despite all the uncertainties, that the global economy is recovering. So we can see here that interest rates, so this model is just showing the global manufacturing PMIs, which is the Purchasing Managers Index. PMIs, any reading above 50 means that it's in expansionary territory, and any reading below 50 means that it's in contractionary territory. So this model is predicting that the economy, especially the US, has landed, and we can expect a similar story in the global economy just based on the interest rates and the easing that we have seen globally from central banks. So to summarize, heading into last year, we were expecting a recession, but excessive government spending has helped GDP levels continue to go up, as well as the economy to look to do a soft landing. But this has hurt the inflation front because inflation has been stickier due to the excess spending as well as money printing. And additionally, we have seen central banks around the world start their global easing process, and we still expect this trend to continue. These interest rate cuts should filter into the economy over the next couple of years, which should benefit the housing market as well as the economy as a whole. And on that note, I think it's a good transition to pass it over to Sebastian, who will give us an update on all our bond portfolios and interest rates going forward.
Thank you, Justin. Always a pleasure to be back in Vancouver, especially when it's not raining. The agenda, quick overview of 2024. The title is exactly the same as last year for those who were here last year, so it was also an interesting year in fixed income. So I'm just going to do a quick overview of 2024, kind of highlight where we see the risks in 2025, and have one specific example that I want to show in terms of how we're continuing to advance sustainability. Maybe just before we get into that, for those of you who do not know who I am and who AlphaFix is, so my name is Sébastien Riom. I'm co-founder of AlphaFix. So we've been sub-advising Genus on the fixed income portfolios for a bit more than 4 years now. So AlphaFix is one of the few remaining employee-owned money managers. And we have a very narrow focus, so we basically just do the boring part of your portfolios, which is the fixed income part. But we really take it very seriously, and we like to think that we're an innovator within the space. So we've shown the innovations that are there. At the end of December, we had 97 clients and 17 billion of assets under management. So quick overview of 2024. Like I said, it was an interesting year. For those of you who were here last year, our theme last year was basically we were concerned about the U.S. economy going in a different direction than the Canadian economy and the consequences in terms of monetary policy. And that's really kind of what we saw in 2024. So the U.S. economy was very resilient. Higher rates didn't slow down the economy. Higher rates in Canada did end up slowing the economy, and that was a lot to do with the relative leverage in the Canadian economy versus the U.S. And when we're looking at 2024, at the beginning of last year, we thought that would be sufficient for the Bank of Canada to start cutting rates aggressively. Usually the central banks tend to do the same thing altogether, but we thought because of that relative difference in terms of direction of the economy that the Bank of Canada would be probably one of the first central banks to start cutting. So as Justin mentioned, the Bank of Canada did lower rates by 1.75% in 2024. They started with lower cuts and then they accelerated the pace, which should be a reflection of the fact that they're more and more concerned about the Canadian economy. So I do think that at the end of December, they're probably going to cut a bit more. And it's probably justified. So what that did is, I don't want to get too technical here, but what that did is it created kind of an interesting impact in terms of the fixed income market. So what I'm presenting here is the yield curve. So it's basically how much you get paid depending on which maturity you're looking at. So if you look at the green line, the 2-year rate right now is 3%. So if you buy a 2-year bond, it's going to give you about 3%. If you buy a 30-year bond, it's going to give you 3.25%. And what I want to show here is a difference between the gray line is where we were last year versus where we are with the end of 2024. So you could see that last year the short-term rates were really high and they actually come down quite a bit. So that's really a reflection of the fact that the Bank of Canada lowered rates. So what's really interesting is that like I said, the lower part of the curve rates came down. But what's quite unique of 2024 is that the 10-year rates and the long-term rates actually went up during the year. So what that means in fixed income is usually there's an inverse relationship, right? So if the rates come down, it's usually really good for returns. And if rates go up, well, then you have negative returns. So depending on where you were in terms of your exposure on interest rates, you might have done really well or maybe not as good. So if you had more exposure to the longer end of the curve, it was a bit more of a difficult year versus if you had more exposure to the shorter end of the curve, it was actually, you had a nice tailwind. And in terms of corporate spreads, so basically how much more does corporation pay to finance themselves, it was a good year also. So generally speaking, the spreads compress, which also tends to be very favorable for fixed income. So how did that translate in terms of the different portfolios? So these are the 4 different strategies that we sub-advise for. And I'll start with the second line there, the Genus Government Bond Pool Fund. So first line, you see it has a duration of 7.8 years. Basically, that's the average maturity of the bonds. So that's fairly long, which means you have exposure of the short term and the long term of the curve. So you can see the return for the portfolio was 3.7%. Nothing to be too excited about, a bit more than the benchmark, so that was positive. But that's really a reflection of the fact that we had, a tailwind and a face wind because we had exposure to the longer end of the curve. If you go to the next one there, the Genus Corporate Bond Fund, so you see the duration is 2 years lower, so you had less exposure to the long end of the curve, and it's a pure credit product, so that had 2 tailwinds behind it. So that was, the big winner in 2024, so 8.2% return for the portfolio, again, a little bit above the benchmark. But the big winner was actually the last one, even if it has a lower return, because this is a new strategy that was launched mid-year. So the Genus Canadian Income Fund, which has a very, very low duration, you can see, so 2.6 years. So basically it only has exposure to the shorter end of the curve. And it returned like 4.8%. Like I said, that's only for 6 months. So that was definitely the big winner. And we do think that in 2025, and you'll see with regards to where we think the economy is going, probably makes sense to stay also a bit shorter in terms of rates because we think that's where we're going to get the most bang for the buck. So where do we see 25? Where do we see the risks and what we see happening in 25? It's kind of a complicated graph, so there's 2 lines. The black line basically tells you the relative performance of the Canadian economy versus the U.S. economy. So if the red line is under 0, that means the Canadian economy relative to the U.S. is doing poorly. And the green line tells you where monetary policy is in Canada versus the U.S., so where are the overnight rates. So the first thing in this graph is you see the black line is very low, right? And it hasn't been this low for a very long time. Again, that's a reflection of the fact the Canadian economy is suffering a lot more from higher rates than the U.S. economy. And while the black line is really, really low, you can see the green line actually has decreased. So the overnight rate in Canada is a little bit lower than the U.S. one, which is fully justified. But that's one of our themes that we set in 2024, and we think that there's still a risk in 2025 for that to continue. So we do think that the monetary policy divergence will continue into 2025. So what that means is that the Bank of Canada will probably continue to lower rates, while the U.S. Central Bank might be a bit more on hold. So that's one thing to keep in mind, because it does has implications mostly on the Canadian dollar, actually, in terms of how that translates. And the other reality is when we looked at 2024 as well as 2023, we had this huge tailwind, right? We had a very accommodative immigration policy. So you can see the numbers here from 2022 to 2024, the population in Canada increased by a little bit less than 4%. And what that does is that if your population increases by 4%, usually your GDP should increase by 4%, because that's one of the key drivers behind that. So in the last 2 years, we've let a lot of people in. That's been really positive for the economy. And that's really hid the fact that, we are seeing a lot of people having some issues with higher rates. And there's a big change in terms of immigration policy. So you're all familiar with this. So the government's come out and said, okay, we have to cut some non-permanent residents. And their target, now this might all change obviously depending on what happens politically, but this is the best case we have. So there's going to be a reduction of 5% in that space in terms of population. So we're going from a nice tailwind to a big headwind in Canada in terms of immigration policy. And that reversal is going to just make the Canadian economy even more difficult in terms of growth. So that's something to keep in mind also. And without stating the obvious, and I'm sure Wayne's going to get into more details in terms of the geopolitical reality that we're going to be facing in the next few years. So this tells you, the horizontal axis gives you how important is trade for countries. So you can see Canada there, more than 50% of our economy is trading. That's imports and export. And on the vertical axis is how much of that is with the U.S. So the higher you are on that scale, the more Mr. Trump is going to make you suffer. So you can see Canada is really, unfortunately, in a very bad spot, right? So trade is important for us as a country, and mostly tied to the U.S. So that really, when you put all that together, so we have an immigration policy that's going to change. We're probably going to have some issues with regards to tariffs. That really, makes us not very optimistic on the Canadian economy. That's why we do think that the Bank of Canada will continue to lower rates, probably more than what's anticipated, actually, because we do think that depending on what happens, again, it's stuff that is going to just make the Canadian economy need a little bit more oxygen through lower rates. I have one slide on the U.S., and I'm sure Wayne's going to have a lot of stuff to talk about the U.S. What's really striking for us, and sometimes people don't realize this, is that the U.S., first of all, still is operating above its potential. And what that means is that if you stimulate an economy that's already operating above potential, that tends to lead to higher inflation. And we do think that in the US, that's probably one of the risks that's the most underrated right now. And the two circles are basically identifying where the economy is currently versus where it was in 2016 when Mr. Trump came first to power. And the playbook that they have is very similar to what they had in 2016, maybe with a few different twists. The comment is that in 2016, the U.S. economy was operating under its potential. So if you stimulate that economy, it doesn't have the same impact that it's going to have this time around. So keep that in mind. So if you see programs, talking about deregulation is going to stimulate your economy. If you cut taxes, it's going to stimulate your economy. That might lead to inflation, which it might not have led to inflation in 2016 and 2017. So that's one of the risks that we want to highlight in terms of the U.S. economy. And I want to finish on, like I said, an example of one of the investments that we made recently in the bond funds. So this is Ontario Power Generation. They had a renewable project that we finance. So it's nothing new about the renewable project, but the reason I'm bringing this up is because this was actually in partnerships with 2 Indigenous communities. So back to Shannon's point about reconciliation, how important it is. So that's one of the themes that we want to push forward in 2025. We've realized that a lot of the issuers that we lend money to actually deal with some of the communities, the Indigenous communities, and we think we have a role to make sure that they understand it's important for us, it's important for our clients, which are you, that the capital being allocated and the projects that are done with these communities actually is done in a way that's to ensure that we're actually accelerating reconciliation. So that's one of the themes that we will be pushing forward into 2025. So yeah, like I said, 2024 was an interesting year, depending on where you were in the curve, the different kind of results. 2025, like I said, we're not super optimistic on the Canadian economy. U.S. economy, I didn't talk much about it, but we do think that it's probably going to be in a better shape than the Canadian economy. And then, like I mentioned, the example that we had in terms of sustainability. So I will pass it over to Wayne.
Thanks, Sebastian. Well, welcome everybody. Good to see you all here in real life. And thanks for coming down to 980 Howe. Well, Justin and Sebastian laid the base case today in terms of what's going on in the economy. The U.S. economy seems to have landed. Canada and the rest of the world are still struggling. And that's a concern. Another big concern here, of course, is government debt. We've got to get a grip on that. It's got to the point of almost no return. And so I'll be talking more about that today as well. So we have the base case in place, weaker Canadian growth, stronger U.S., and now we have the Trump agenda coming, and that's the big thing in front of us, and how the world's going to react to that. So how we see it is that the markets have discounted this U.S. recovery. They've done very well through the course of this year. It's been a fabulous year on the stock side. But towards the end of the year, bond yields in the U.S. backed up because of higher risk of inflation and the Trump agenda. So right now, the Fed's on hold, the markets are on hold because of the Trump agenda. And we see stocks as being in neutral right now. They've done very well. They're a little expensive. So we're kind of neutral in that space right now. We favor the U.S. It's pro-growth agenda. It's going to favor U.S. companies as it has for the past 10 years. And the Trump agenda is pro-growth, definitely. They're going for gusto here. They've got to solve this debt problem. If you look, probably the most important chart you saw today here was debt to GDP. They have to get the GDP growing fast and growing with low inflation to bring that debt to GDP number down. They have to raise the numerator and shrink the denominator. They have to shrink the debt. And the best way to do that is to go for growth, and they're going to go for it. And we'll see how. The big thing is for them to deal with, of course, is the inflation side of things. So right now, where we're sitting, we're overweight cash. We have about 10% cash. We have some dry powder. We're watching and waiting for the Trump agenda. And we're neutral on equities, underweight bonds, and overweight commodities. Now let me get into the gory details. Okay. So what's happened in the last half of the year? The Federal Reserve started to cut interest rates in September. Right before the election, they cut rates by 50 basis points, and then they cut them twice more. They brought rates down 100 basis points. But on the other hand, long-term rates, the U.S. Treasury actually went up 100 basis points. So very rare for that to happen, for the Fed to cut rates and the bond market to raise rates. So what happened? Number one is there were economic surprises. The Fed was kind of wrong. The economy came in hotter as expected, as Justin mentioned. Part of it was government, part of it was the AI spending. And then there were concerns about U.S. debt. They're growing their debt at $1 trillion every 100 days. And so the bond market started to back up at the long end because of that debt concern. And then the last wave here from November, obviously, was the pro-growth Trump agenda. So that's kind of put the Fed on hold. The bond market and the Fed are aligned, as Justin showed you. And where do we go from here? So the bond market in the U.S. doesn't look like it's in that bad value. I've been showing this chart here for probably 14 years. We started unveiling this after 2008, 2009. It shows the real interest rates, the spread between what a Treasury and index bond will issue. And right now, real rates are around 2.25%, high as they've been in 14 years. You see how low they got during the previous 10, 12 years. It was really a period of easy money where they were printing money hand over fist, and governments were spending money, and central banks were buying bonds. So that really drove real rates down. Those days are over, folks. It's done. It's over. They ain't coming back because they have so much debt out there. They have to start cutting the deficits. Justin showed you the interest payments going up. They've got to start cutting those costs. There's over $1 trillion now in the U.S. It's bigger than their defense budget. So something has to get done here. And so we're going to be stuck with these here until we solve the debt problem, until they solve the debt problem. And that's where Doge comes in. They have to execute there. So we'll see how that plays out. So as well, Justin showed you how the consumer has been hit and hurt by inflation. Their real wages have shrunk relative to trend, and how governments have, that's how they deal with the debt, right? And they've been doing this for thousands of years. We've seen this movie before. Well, corporations in the U.S. have done pretty well. Corporations they've done a great job passing off inflation to the consumer. And that probably will go on until we get another recession. As well, AI has really driven growth in terms of technology spending. And this is really pumped up by the Magnificent Seven. It's really driving that as well. So it's really been, it's good for the U.S., but the rest of the world is not looking as good. And you can see here that over the past 20 years, we have the orange line is the U.S., the blue line is the world x the U.S., so it's the rest of the world. The rest of the world's earnings have been flat for 20 years versus the U.S. being up 3.5 times. And that's why we're overweight the U.S. and remain overweight the U.S. They're growing their earnings faster than the rest of the world. And they're creating more wealth. They've got more technology. They have more innovation. They have a bigger VC market, for example, for creating new ideas. They have less taxes, less regulation. And so I think you're going to see the rest of the world. Europe's talking about responding and doing things to try and catch up. And they have to do a lot of that, obviously. Now, one good example of innovation you're all familiar with is obviously NVIDIA, which really owns the AI market in terms of chips that go to the GPUs that go to the AI market. It's reminiscent of IBM back in the 60s when they had the mainframe. In fact, these guys have probably they have a stronger position, I think, than IBM. And you can see over the past 2 years, we have a chart here. The orange line is their earnings, which have gone up tenfold, and the price has gone up tenfold. So the price has simply matched the magnificent earning growth over the past 2 years. The stock was trading at 30 times forward earnings back in 2023. It's still trading at 30 times forward earnings. And the analysts are projecting growth over the next 5 years of 30%. And so we don't think that's a big stretch either. So we've been overweight the stock through most of the year. We've been selling it, of course. As scale goes up, as they get bigger and bigger, it's hard to get that growth rate in. Even at some point in time, you simply can't get those 30% because you're so big. You saw it happen with Microsoft. It could happen here as well. But if you look what's going on in the industry, this is the capital spending in IT. This is from International Data Corp. You can see that they're expecting about 65 billion-ish in capital spending in the space in 2024 and over 105 in 2028. And these are low expectations. 2 days ago, we had the Stargate come out projecting 500 billion to invest in the space for AI infrastructure, data centers, and other issues. A JV between Oracle, SoftBank, and OpenAI. So, and that's really, you can see the Trump agenda is really behind this. They're really pushing AI. They want to be this leader in there and globally. And it also has geopolitical issues in terms of having a superiority there, has military and geopolitical issues as well. So they're going to go hard on this. I'm sure the boys in the CRA behind us as well. So so this is pushing infrastructure. And we think this big move here, the pro-growth, is going to impact the U.S. dollar. It's going higher the way we see it in terms of, not just because of the tariffs, but because of the growth generated there. And it's been up, from 2008, the U.S. dollar bottomed. It's up 50% over the past 16 years. And we think it's accelerating again right now, just given how strong they are and the pro-growth agenda. And this will help mitigate their inflation. When their dollar goes up, it means they can buy cheaper goods abroad as well. And some of the sectors that typically what happens when you have the dollar going up, it hits the resource sector. At the very end here, you can see the sectors that get hurt the most: materials and energy. Commodities get hit as the dollar goes up. It brings down other commodities. I would say that just a throwaway comment. Gold has been doing very well because of all this inflation and government spending, right? If Trump is successful with his pro-growth and reduced deficits and get a grip on this could have a negative impact on gold. But he's got to execute. So good luck with him at that. On the positive side, IT, communication services do well, financials do well as well, and consumer discretionary. Right now in our portfolios, we're generally overweight the consumer discretionary, financials, and around market weight in IT. And I think we have the good names there as well, which have been helping our performance. Now, looking at the overall market, as I mentioned, it really had a great second half. We have two charts here. The blue chart is the actual S&P 500, which has all the big weights in there. NVIDIA, all the hyperscalers are in that as well. And then the orange is the S&P equal weighted index. It's the average stock out there. You can see the median for the blue line is around 16. It's up around 22, much like what happened in 2022 when technology got ahead of itself. So, but part of that too is that people are expecting higher growth. So with the higher growth, you get higher multiples, but it's a little ahead of itself right now. The average stock looks pretty good. The median's it's selling around 16 times. The median's been around 15. And I think for the market to do better next year, it's going to have to broaden out. We can't have this technology carry everybody. And that's why we're at market weight. And we think that there's good value in the financials with growth that's going to be good. And in some of the U.S. consumer discretionary. Now, without further ado, let's get to the big issue of the day, the Trump agenda. What we did here is we laid down some of the initiatives and then want to talk about some of their potential implications. Number one, deregulation. As Sebastian said, it's pro-growth. It helps reduce cost, and it also improves productivity, and it really has a big impact. In fact, we saw the small business sentiment indicator in the U.S. jump the highest in 40 years after Trump came in. Lower taxes, it's pro-growth. It should increase profits and also capital spending, which longer term has capital, which has productivity enhancements. Now, his way of dealing with inflation is the drill, baby, drill. As well, this whole AI move, the major constraint in the AI move really is not the chips, it's the energy. They have to get energy, they have to get clean, cheap energy to these data centers, and they need energy. And also, it'll give them, you can see the very bottom, raise sanctions on Russia and Iranian oil. If you do that, and that's why Biden didn't want to, actually Biden did that as he was closing the door out of the White House, he raised the sanctions against the Russians because he knew it would impact the oil prices. The week after that, oil went up around 10%. So they want to drill, baby, drill, and have impact on those sanctions to have leverage on Russia and Iran. So they're gonna open up the spigot there and try and do what's going on. Deportations. I'll come to tariffs. Don't worry. I'll come to tariffs. Deportations is definitely inflationary. You know, a lot of the lower cost labor, agricultural, service sector, hotels, etc. The whole southern part of the U.S. runs on that. Okay, that's going to have an impact on that if they start cleaning that out. So getting on to tariffs. Well, tariffs. You know, we believe that tariffs, all the Trump talk about tariffs is not a negotiating tool. It's not job owning and trying to get leverage. We think they're dead serious about tariffs. And we think that the idea there, tariffs will be big, but they will come slow. They can't upset the apple cart. They can't have too much of a volatility hit the market. At least I hope not. I trust that he's got two senior advisors working for him, Lighthizer and Navarro, who are both in the first team. They're working on this, and he's revealed some of the points. He's a big fan of McKinley, who was in the tariffs. They've also created they have the IRS. They've created the ERS, External Revenue Service, and what they want to do, obviously, is lower domestic taxes and raise tax on foreign production, and which is tariffs, right? So, and I think this is not. They're going to longer term. This is where they're going to go, and hopefully they go there slow, and give us a chance in Canada, the rest of the world, to respond. Our policymakers will have to respond in kind. We'll have to do the same thing. We'll have to lower our domestic taxes and raise taxes on imports. So we shouldn't, Heads are exploding right now in Canada. I get that. But we have to be rational, and and as Sebastian said, they have more leverage on us than we. We're a part of their overall trade package. I think from just looking at Canada's trade with the U.S., it's pretty even Steven, I'd say, except for energy. Most of you look at the net flows, like the auto sector, the dollars are almost equal. And you have parts going back and forth over the border. Good luck with making that work on tariffs, either side. So I think we should approach this as there's a new regime in place, a new tax regime in place that's going to probably be in place, at least in the U.S., which is going to impact the rest of the world. We should adjust that accordingly, and with a lot of thought and seriousness, and have talk. So I can't wait for Trump just to go away and for the policymakers, the Scott Bessents and the other policymakers, to come out and actually have a sort of an adult conversation with us in terms of what their vision is and where they're going. So, and some of the work I've seen initially in terms of tariffs, if the tariffs are up 10%, 4%, the currency gets hit by 4%. So right off the bat, currency gets hit by 4%. Our currency's already down. It's down about 8% in the past 4 or 5 months. And so the other 6% is, clients we can shift, we can go buy, rather than buying, say, a Ford, we can go buy a Volkswagen or something from somebody else. And then also, our manufacturer will have to cut margins too. So it's the impact is diversified. And I think so if it's slow and steady, it'll have, that's what we want. We want to have, if there's changes in tax policy, they're always best when there are lots of visibility and they happen over time. So the other thing here too, aside in terms of tariffs, is besides tariffs, the most important thing is DOGE. They've got to come to grips with the deficit. So I would say another thing too, in terms of we are running a surplus with the U.S. Most of it comes from the resource sector. The net trade is the resource sector, mainly energy and commodities. And you hear Trump talking about us going to 2% of military spending. I predict that in the future we'll ship them oil, and they'll ship us tanks and planes for us to get to our 2%. Would be one way to balance this whole thing, right? So, anyways, I hope we get a new government here soon that they're going to actually work on this, that have the population behind them and the authority to do what they have to do and deal with the U.S. I think it's going to be really important in terms of how it plays out, negotiating with the U.S. And I hope we have time and a lot of thought go into our new policy. So where does that put us from our asset mix right now, where we sit? So right now, we're neutral in equities, as I mentioned. And within equities, we like the U.S. versus the rest of the world in terms of pro-growth. And we also like cyclicals. It's more of a growthy kind of economy. And we're underweight bonds marginally. And within bonds, we like the corporate sector. And commodities, we're underweight. And currencies, our models are still negative in the Canadian dollar, but the Canadian dollar is in a range here until we find out what's going on. It's good value, but how do we get through all the tariffs here? So as of January 15th, as I mentioned, we have extra cash. We're at 10% in cash, the highest we've been in the past 3 years. Our equities at 66%, close to benchmark of 65. We have zero commodities, and our bonds are a bit below benchmark. You can see our dividend strategy. We had 27% back in 2022. We're now down to around 12.8. We brought that down quite a bit. That's for two reasons. I said we're more cyclical than defensive right now in our perspective, our view. As well, the bond market, as I showed you, the real yields are pretty good these days. So the bond market's offering better value. We were using that dividend strategy as a bond proxy when real yields were so very negative. So look, bond market's better value now. We're getting a better carry, better yield on it. So we put more bonds into our portfolio and reduced our dividend strategy. So beta adjusted, though, takes into account the fact that dividend strategy is a very low beta, low market sensitivity, about 0.8. And so really the effective equity weight versus the benchmark is a bit below at this point in time. So we have We have some extra cash. We're neutral on equities. We're watching our signals, our models, and we'll see what happens with the Trump agenda, which is going to be unveiled over the next couple of months. And we're ready to raise more cash or put that cash to work, depending on what our signals say and our perspective. And with that, I'd love to have some questions. Are we into questions right now?
Yes, we are.
Okay, let's do it.
So I have a mic down there for all of you if you want to have a seat again.
Okay.
Thank you. Thank you very much. Wonderful. Okay, so the way that we'll handle questions is we'll start in the room, and then I'll make sure that we also go out to the live stream. We are a little bit over on time, so for those of you who can stay on the live stream, fantastic. And obviously those of you in the room as well. So any questions in the room? We'll start with the physical people. Oh, everyone's quiet in the room. Okay, well, I have a lot online, so we'll just, Margaret. Okay, go ahead, Margaret. Oh, sorry, let's grab a mic so the online people can hear you. Thank you.
What are we doing in the portfolios to hedge against the strong U.S. dollar? Are we, enacting some hedging strategies in equity or fixed income?
So Wayne can start that and maybe then pass to Sebastian.
Oh, yeah. Well, actually, in our balance fund right now, our U.S. dollar exposure is around 70% plus. So your portfolios have a lot of exposure to U.S. dollars, and that's helped our returns last year, obviously. We're actually more concerned in looking at creating strategies the other way around. When the Canadian dollar does come back, that's when our clients' wealth gets eaten up. So because it degrades foreign assets, right? So we're concerned more about when the dollar comes back. I'm not saying it's coming back, but it will come back at some point in time. It is undervalued. You look at the prices compared to here to there, purchasing power parity. That's more of our concern longer term, and we've been short marginally, just underweight at 1 or 2% in our portfolios because clients have done well. I think the balance fund last year, correct me if I'm wrong, Justin, but probably got 6% from the weak Canadian dollar, most likely, right? So it's helped our returns on the way down. So we have enough exposure there, and we've got it ready for the turn, whatever that may be.
Do you want to go to Sebastian for the bond perspective?
So kind of similar as Wayne explained. So we're starting to build a Canadian dollar position in the U.S. fund to take advantage of the fact that it's always tough to determine where it's going to go, but we do think there's offering value there. So all the Canadian dollar portfolios have no exposure to the U.S. dollars, and obviously the U.S. portfolio has exposure to the U.S., and we're starting to build a Canadian position in there to take advantage of the renormalization of rates. So kind of what Wayne explained also.
Yeah, we're not there yet. We're watching and waiting. We want to see the whites of their eyes until we get some visibility here on the Trump agenda, but we'll be ready and looking. There's a lot of institutional money now going into the Canadian dollar, starting to load up on it because they see it as being undervalued and maybe more bluster than that from the Trump pulpit.
All right, well, speaking of bluster from the Trump pulpit, apparently this morning there was a reiteration of the tariff threats in a Davos speech from Trump. So a couple of questions around tariffs, because I think even though we've talked about it quite a bit, there's still some more. So the first one is around the definition of a tariff, essentially. So this person asks, and this is someone online, isn't a tariff simply a blunt consumer tax? Don't these generally cool the economy that initiates them?
Yeah, and I agree with that. It's, if there was a tax rate in Canada, if they put tax up, or income tax even higher, it wouldn't be called inflationary, it'd be called, it's going to crimp consumption. And we saw what happened in the 30s with the tariff war, right? So it's a one-time hit. And I think longer term it takes money out of the economy, hits consumption, hits everybody. So there's been a big debate over that. I should have talked more about that when I was up there, but I disagree with the fact that it's just purely inflationary. It's a one-time hit, and it can be deflationary longer term if this thing really amps up. And you have all kinds of uncertainty. So I think going slow is very important, giving people, corporations and countries a chance to adjust their policy.
Okay, great.
I saw the speech this morning.
Yeah.
This was on the way in, on my way in, I was listening to Davos speech. Here again, I guess, my take is that, as I said, bigger but slow is where they're going. So right now they have tariffs on China of around 25%. And China is the big threat to the Americans. You see it, across the whole, they're hawks on China. Yet he's beating the heck out of his best buddy next door, the Canadians. This morning talking about 25% tariffs, they're just ripping us off. The numbers aren't that bad. I don't think he likes the Trudeau government. That's number one. I think they basically, and that's a big part. He's been talking to his bro Xi in China. But I think my theory again, big but slow. They want to come, right now China has 25%, we have none. And if they want to harmonize that, we have to go to 25%. Same with Mexico. So if they do that, so he's the front man selling this 25%, giving us a peak. If they're going to harmonize longer term, we all get 25%. And so maybe that's what's going on here. We're bad because he wants to harmonize. Anyhow, that's my perspective, part of the big versus slow as well. So, we'll see where it goes. But it's the big versus slow, and very big and slow, I think, is where it's going longer term. And that's what he's saying now matches that perspective.
Okay. Great. Anything else in the room, or else I'll go to another online question. All right, let's shift gears away from Trump for a second.
I'll say one more thing.
Oh,
just
okay.
one more thing.
Maybe not quite yet.
This thing too is, just one more insight, is that, we have GST. We have a GST which goes on all goods sold in this country, including foreign ones. So we have a tariff right now on U.S. goods coming into here. So that's food for thought. So if he puts in 25% tariffs, we should jack up we should put a tariff in place of, say, 19%, which would would be both at 25% effectively. So that's just, food for thought in terms of, we have to sit down and harmonize our tax structure with theirs going forward. And hopefully we can do it in a peaceful, thoughtful, organized manner.
Great,
Sorry.
thank you. No problem. All right, we'll take a couple more. We're running a little bit late, so I'll take it to 1:15. So a question for Stephanie about ESG versus traditional. So how do we quantify the return of ESG versus traditional? There's three questions in here, actually. So how do we quantify them? Is there a return penalty, I assume, on ESG is what this person meant? And also, how much risk does ESG reduce versus traditional? So how do we quantify return? Is there a penalty? And what about the adjusted risk?
So we have previously done pretty extensive analysis looking at 20-year horizon, 10-year horizon, to look at companies' performance, those companies that have better ESG, better sustainability policies and evidence over the long run versus traditional investing where oftentimes they don't have specific or explicit ESG policies or sustainability practices. And what we have found from that analysis is over the long run, better ESG performance does translate to better financial returns, if that's what the question is referring to. Yeah, and also on the flip side, better, more sustainable companies, they tend to have lower risk too, because usually they tend to be more responsive to market trends, and they're usually they have a higher efficiency in terms of, and also productivity. So these companies usually, they are more able to respond to threats and changing landscapes. So from a risk perspective, or just talking about risk-adjusted return perspective, from a lot of empirical studies, our own studies have shown that it has done better.
Great, thank you.
So, and also, we've had, at Genus, we've had our responsible products and our fossil-free products. We've been able to see them over the years, and they performed pretty well in sync. They have different cycles. When cyclicals do better, our conventional responsible tend to do better. We also, when we create a responsible, and Steph can go probably more on this than I can, we also go back and back test the impact of these different screens. And we have a commitment with those clients in that space that we're focused on return, but we will add all these things that help us add value. And one thing we just discovered, as Steph said this morning, is that the impact factor, the SDG, does add value. It's a positive thing, and we'll see where that goes. But we're focused on return. We think we can even do more research. And this will be Steph's focus. The focus on more research, where we can use some things like impact and ESG and fossil free to enhance our alpha and returns in our portfolio.
I also want to add something. Yeah, so it's very interesting. We also look at quite a few different factors like in ESG space. So on the E side, so carbon intensity. So we basically look at the difference of returns of companies of lower carbon intensity versus higher. Over the long run, they really do kind of have a positive impact in terms of performance. Another key thing that on the social side is gender equality. We also look at that factor, and that factor also, if you look at the difference between companies that have good gender equality measure versus those with less of those, that is also a kind of a return enhancing factor. And then also governance is also shown to be a good factor in terms of adding performance. So so these are just some findings that we're not just saying it, but we have seen evidence of it.
Fantastic, thank you. So I will stop the questions now, just for those who are online particularly, so that we're not keeping you much past the time that we promised. But I will say that if your question did not get answered for any of you online, there are two options to get it answered. One is talk to your portfolio manager. They're always there as a resource for you, so any question that you have for them, please reach out to them. If you're not currently a Genus client, then I would recommend going to the Genus website, and you can easily contact our team, and we'll have someone respond to you, and you can have a full conversation, not just have one question answered. You can ask multiple if you like. So thank you all so much. Thank you, presenters, for all of the amazing insights today. Thank you to the team who made this possible. It definitely takes a village, particularly Graham Farmer, who's our marketing lead. He was the lead on this event. Encore, our AV team, is amazing, and they are who helped us bring this as a live stream as well. And Mary Lou Miles for all of your help. Thank you with that. So one last thing for those of you who are still online, if you could stick around for a couple of seconds after we finish the live stream, you will be redirected to a survey about this event, and we would love your feedback in terms of what you found to be useful, what we could do better. So we would definitely appreciate that from you if you wouldn't mind just sticking around. For those of you in the room, you'll be getting the same survey via email. And again, we would really appreciate your feedback so that we can always strive to make this event better and more useful for our clients and for our community. So on that note, we'll wrap it up. Thank you all so much, and have a fantastic day. For all of you in person, feel free to stick around. We have this room for the rest of the day. So if you want to talk to any of the team, have some more to drink, we would love to chat with you. So thank you so much for coming.